everyone, let's do a quick sound check. Please let me know if you could hear me. Hey, John, Christopher, Alan, Elijah. Let me just share here my screen. Hopefully everyone is doing well. All right, so before we begin, I just want to make sure everyone's aware of the risks of trading. I'm required to let you know that trading is risky. Please do not trade with funds you cannot afford to lose. Be careful, practice. You've probably heard this before, but you should be aware of the risks of trading, whether it's futures trading, forex, options, stocks. So please touch base with your broker, refer to the terms and conditions when trading, right? Trading is risky. All right, everyone. So to begin, what I'm going to do today, I'm going to go over a few things we've seen in the recent days. The volatility has been stronger than normal. So this is obviously something different that we haven't encountered as traders, where the last year or two or more, the market's been very slow. So we have to adjust the way we trade under more volatile conditions. We have to approach the market differently. We can't really trade the same way. The stops are different, the targets are different. It's just the way we manage overall the situation when the market is strong and it's compared to when it's slow. So let me remove this here out of the way. This is the Day Trade to Win webpage, by the way, in case you're new to Day Trade to Win. The website has a lot of information, so please feel free to review the videos. We have trading videos, testimonial videos. We have the member videos here for the traders who have the Atlas line or the Trade Scalper. We have a blog that is very informative. We have an FAQ here, I think is important as well. If you want to understand just the basics of trading, the FAQ is very important to look at. All right, so to begin, here today is December 6th. Can you believe it? The holidays are approaching, and being the end of the year, typically there is a lot of activity that is approaching the markets for buyers and sellers to prepare for tax season. You should expect the market to increase in volatility. I'm going to add the at the open. I'm going to add the Atlas line. I'll show you a few things. Really, what I want to start off with before I bring up the ATO and the Atlas line, which should be firing off momentarily. So what I want to do here is look at yesterday, and the reason why I'm going to show you yesterday here is because one of the methods, one of the ideas that I bring as price action is so important when trading is this idea of looking at the candles throughout the day. Now, I think that the first few hours of the trading session is the most important because the volatility is better, you have less manipulation, you have some news, so you have a lot of activity happening here in the first few hours. And what we have during the first few hours is an opportunity as a buyer or a seller to take advantage of these moves. But as we move forward into the day, really after the first 2.5 hours, what we have is the market in this middle zone, or the lunchtime area as it's often referred to, even though it's not really lunch for everyone in the world, but it is considered the middle part of the day. I call that the B part of the day, the middle part of the day. It's being recorded, yes. And what we're going to do is look at this relationship between the first part of the day and the middle part of the day to help me understand whether or not we have a trend. Now, this method is called the ABC method. This is free to everyone. I showed this as a video. The software that goes along with this method is provided to you with mentorship or with one of the products we have as a bonus. In reality, you don't need the software. I'm a believer that you don't need software to trade. Specifically, you should understand why you're buying or selling even before the software gives you the entry. So this ABC method is something that everyone can do on their own, whether you use NinjaTrader or TradeStation or MT4, MT5, whatever platforms you use. And this is universal across all markets. So what I want to do here, just as an example, using the E-mini S&P, for me, at 9:30 Eastern Standard, when this market opens in my time zone, you have a lot of activity, and you can see that from the ATR. And the ATR, the average true range, is set, as you can see, to a setting of 4. That means we're only looking at the last 4 candles. So what I'm looking at here is between 9:30 and the first 2.5 hours of 12 o'clock to indicate to me that we have this buying and selling activity, usually the ATO and the ATO2 software, the Atlas line, all of these signals, which I'll bring up in a moment, fire off. You have a lot of opportunities. And I don't mean 30 opportunities. I mean good, solid 3 or 4 opportunities if the conditions are right. And as we go forward into the future here, and so let me just write this down here from 9:30 to 12 p.m. Eastern Standard, New York time. As we go forward into the future, the next 2.5 hours, which happens to be from 12 p.m. to 14:30, allows a different situation, which is 2:30, because this, as the B part of the day, allows me to understand whether the market is in a trend or not in a trend. Now, what we consider a trend for some traders is not the same for others. So if you look at this market right here, what I see is an up and down chop or a range or a channel. I see that because I see the market come up and then I see the market come down. But as we move forward into the day, if we have some evidence that the market is continuing, that would be indicating there's a trend. And therefore, how do I put that into a rule that says there's a trend, and how can I take advantage of what a trending day brings to me? Because a trending day is typically a difficult day to counter or to fight the trend. Usually, if you go with it, you're in good shape. So what I want to do to identify a trend as early as possible is to outline the highest high here, which is between 9:30 and 12 o'clock, like this, and identify the lowest low of A, the first 2.5 hours. And it's a little different for other markets because they may not start exactly at 9:30, like the oil or the bonds. But the idea is still the same. You outline 3 parts of the day. So for the E-mini and the financials, 2.5 hours. And this area here allows me to understand that if it continues beyond, which is above or below this area, I have an opportunity. What I'm focusing on is going to be 2 consecutive candles closing above or below as proof, as evidence using price action that there is in fact a trend. So as we go forward into the future, beyond the first 2.5 hours, immediately 12:05, 12:10, 12:15, 12:20, what I want to do is verify that the market is in fact moving higher and higher or lower and lower. It's not difficult. It's very easy to see, and I think it's objective where you don't really have to think too much about it, where you can see, well, the market is breaking above or below this area. And if it doesn't happen, that means we don't really have a trend for the day. We have maybe the market moving up a little, down a little, but it can't be considered one of those strong trending days where you just buy and hold or sell and hold. The goal is to look at this as it happens sooner rather than later. So if you look at a situation where the market is, let's say, beginning to move lower, 2 consecutive candles as early as possible, as soon as 12 o'clock rolls around, is the best option. So I want to see immediately this happening to tell me that there's a trend. Now, if it doesn't happen, and it specifically within the first hour and a half, that means that there's no trend. So within the first hour and a half, which is 1 o'clock, this has to happen to say and to indicate that there is in fact a strong trend for the day. And now you can buy, you can sell, you can hold it, you can trail a stop, you can do all those cool things, but it has to happen within the first hour and a half. So as we approach here 1:30, here at 1:30, right over here, if you see my chart there, the market does not break above or below not by one candle, not even by two candles. It's actually testing. Maybe you can consider that double bottom or double top. It's testing the lows and possibly the highs. So you can see how very strong support and resistance is outlined within the first 2.5 hours of the session. Now, as you go forward in time, this relationship between A and B can also be looked at as this idea between B and C. And between B and C, which happens to be from 2:30 or 14:30 until the close, so this is only an hour and 45 minutes. This is the C part of the day. This is where we have late day rallies and late day sell-offs. Not that common, but we are going to look at when the market, now there's relationship between what happens in B right here, the highest high and lowest low. Let me just crunch up the chart here a little bit. The highest high and lowest low now as we go into C. The same is true. Two consecutive candles closing either above or below tells me that as we go into the close of the day or the end of the day or the end of the session, there's a sell-off or there's a rally. So again, it's the same idea. Two candles closing either above or below, like this or like this, will allow me to buy or to sell as we enter into the end of the day. So this here, as you're seeing this unfold, may not be a trending day early on. And to give you the example, I would only think of this as a trending day with two consecutive candles closing either above or below the range of A. It didn't happen, but there was a late day rally or sell-off. You can't expect this to happen every day. So if you look at day in and day out, markets don't really trend and they don't really have late day rallies or sell-offs as we go into the end of the day. What usually happens is the market goes up, market goes down, market goes up, market goes down, and this is where everybody gets chopped up. And this is actually where I prefer to be a trader. I really enjoy to see, or I really prefer to see markets that do this as opposed to trend. Because with a trending market, you never know when the trend is going to end. And trends definitely have a limited life. They don't last forever. They start and they can pull back or retrace or reverse at any moment. So for me, I really prefer to see this type of activity up and down. So now, as I look at this type of day, how can I take advantage if it's only here in the end of the day? Well, if I remove this here and I add, for example, the Atlas line here and the ATO, so that's the Atlas line. Now you can see how the market can give us a long and a short on an up and down flip-flop type of day, especially here in the morning, and then continue to give signals as the day just keeps on going and going and going. So from this moving forward, the only option is a short signal yesterday with pullback and strength trades, maybe bounce trades, or anything you want to do short because the price is trading below the Atlas line. Now, it doesn't mean you can't buy it, but it has to be specific. Why are you buying the market? Is it because of a roadmap signal or an X5, all these other methods that I teach? But for the most part, the Atlas line only gave you short signals and only long signals here. And the same thing is true if I go back to the day prior. The only signal here, or the only direction, would be to enter short. And if you look at the ABC method or the ABC pattern, what I've just shown you, I'm going to add here the ABC just to give you the idea of what the ABC looks like as software. Like I said, you don't need the software, but I have it here coded. You see, not only did the Atlas line provide a short signal right in the beginning of the day, but the rules outlined with the ABC from here is as the A. You don't have a short to say go short. There's a trend in the middle part of the day, but as far as a late day sell-off, it exists. So this is telling you, let me just remove this here. This is telling you to go short for those same price action rules I did manually. And the same thing is true if I look at what I've just did here. The same thing is here. ABC short to go short, two candles closing below here to go short. And the same thing, the outline is cooperating. So whatever type of trading that you're doing, whether it's using moving averages or MACDs, always refer to price action as a buyer or a seller with evidence. I think shooting from the hip is not the right way to go. Look at now the market beginning to trade. Here for today, I'm going to look at the signals, Atlas line, ATO, whatever happens to come my way, I'm going to provide the signals. I have my dome here. I'll do a little trading with everybody. I'll show you how this is done. Is anyone here new to trading? If you need the basics, I'm happy to explain the basics as well. And let me add the ATO to here as well. And I'll add one more thing here. This is the roadmap, which is outlined in the mentorship class, which is a great little filter that says whether or not we should be buying or selling based on manipulation. So as soon as the market landed in this zone here, which is the roadmap zone, it would indicate don't buy it, don't go long, because the market may reverse and you have to filter out any long trades. So if you went long because you saw these three large candles, this would be the wrong thing to do, at least not at this roadmap area. And the same thing with this zone here. And so this plots it for you automatically, and it's explained during the mentorship class. The next class begins on the 18th. That's correct. December 18th. It's the last class of the year. So if you're interested in joining, just send us an email. We'll send you the details for it. So the outline is about to provide a signal momentarily. And so what I want to do is I'm going to wait until we have the signal 2627 long. 2627 long. So I'm going to place here a 2627 long. But before I do that, I'm going to make sure that I have here the ATM strategy,
order filled,
which allows me to have a target and a stop automatically. So the ATM strategy on NinjaTrader does this for me automatically. The next thing is the stops, the targets, the trade management. The ATR is 2.25, 2 points, 2.25 points. So what I'm going to do is place this as a relevant target and relevant stop to the conditions that exist. I can't expect 6 points, 10 points, 5 points. I can only expect what you see here, which is 2.25, 2 points if you want to be conservative. And as the market reaches here, I want to be out of the trade. Obviously, I don't want to have a losing trade. If you are taking these trades with me, just remember, exit the trade, get out of it at a market order to ensure that you get filled. You don't have to use limit orders or market if touched orders. If it touches 26, 29.50, you need to get out of the trade as well. That would be a 2-point target. And the stop is also down here. You don't have to have such a large stop, but protecting yourself with a catastrophic stop is important. So a catastrophic stop is always placed, and then managing the trade with a time element, with a proof element, and with a catastrophic stop, a well-rounded protection, not just a hard stop. A lot of traders just use time or price. I use a combination of price, time, and proof, so that you are covered in case anything happens along those lines. Now, in addition, let me give you just a quick tip here. If the market slows down,
Target
this will
filled.
also slow down. All right, so that target was filled, as you can see. This is a simulated account. If you'd like to continue watching part 2 of this live webinar event trading challenge, please visit DayTradeToWin.com or click on the next video.